Thanks for tuning in to this week's iteration of our weekly investment briefing that we call Cutting Through the Noise. I'm Tony Welsh, Chief Investment Officer at Signature FD. So, as always, we'll go ahead and start with our chart of the week. And we call this one U.S. leadership is breaking down on an equal weighted basis. And this is something we've been talking about consistently throughout the year that international stocks have been leading the way versus U.S. stocks. And we're going to show that in a chart on the next slide. But we've been showing that analysis based off of a market cap weighted index. So it's really comparing the large stocks in the US to the large stocks in international markets. And even on that basis, international stocks have been a leader. But this chart here caught our eye because it shows an equal weighted version of US stocks versus an equal weighted version of global stocks. And you can see that the breakdown has potentially been more severe on an equal weighted basis. And so what that tells us is that the underlying trend of international outperforming US has been quite strong. The average international stock has done better for the last year, year and a half than the average US stock. Now, that's something that we do have on our radar as potentially being a longer term secular trend. If you recall, earlier in the year, we did take some money out of US markets and allocate it to international markets. And that could be kind of a structural story if international markets continue to lead. So we did think that that chart was an interesting view. But when we zoom out and look at a wider swath of asset classes, you can see that most asset classes have had some corrective action in the last week or two, but are still in pretty well-defined uptrends. So we can see here the S&P 500 still up 13.5% year to date, small caps up 7.5%. And those international markets have really shined, developed international markets up 24%, and emerging international markets up 27%. So the uptrends are still intact, and there's certainly been international leadership to go with them this year. Now, when we turn to some of the economic data that we got last week, it was generally better than expected by most of the indicators that were released. So here we're showing the flash PMI estimates for November. So this is supposed to capture the early respondents for November activity in both the services sector and the manufacturing sector. And we can see here that any reading above 50 is consistent with expansion. Any reading below 50 is consistent with contraction. And what we can see is that generally the manufacturing sector looks okay and the service sector looks pretty strong. And those come together to form a fairly solid number on the PMIs. And this has been kind of bucking the expectations that you'd have some economic weakening. But the PMIs do show that growth has been resilient despite all the uncertainties this year. And then job creation also surprised to the upside for September. So we can see we may not ever get an October jobs number, or it may be very late. But for September, we did create more jobs than the market expected by about double. But you can see, if you look at the top clip, that orange line is the moving average of job creation each month. And you can see that it has been trending lower over the last few years. So there still continues to be some softness in the labor market, but still relatively healthy job growth that's consistent with an expansion. Now, on the flip side, why I would say that there are some mixed messages in the data, the unemployment rate did tick higher to 4.4, and it actually wasn't that far from being rounded up to 4.5 for September. And if you look at the confidence surveys where they ask people, are jobs easier or harder to get, they're generally saying that jobs are hard to get. And if you apply those sentiment readings to the unemployment rate, it would imply an unemployment rate of 4.8% right now. So there is some upward pressure on the unemployment rate, and that is something to watch, especially since there's been big changes to the labor force this year through the policy mix. So we are keeping our eye on the unemployment rate. It has ticked higher, and that does have our attention. Not recessionary yet, but something to continue to watch. Now, turning to the fundamentals, earnings were pretty solid here for the third quarter. Now we're starting to look at the fourth quarter for earnings, and that's what the market's going to be trading on going forward is the fourth quarter and beyond. And what we can see here, this just shows the absolute level of earnings per share that analysts expect on the S&P 500 for each quarter. And so for the third quarter, earnings per share was almost $73. Well, for the fourth quarter, it is expected to downtick to about $70. So a pretty small downtick, but a downtick in the earnings picture. Now, earnings that would still represent growth on the year over year. So when we compare it to the fourth quarter of 2024, that would still represent pretty strong growth on a yearly perspective in earnings. But it is notable that on a quarterly basis, they are expected to turn a little bit lower. And we need to also watch, much like the unemployment rate, we also need to watch to see if that's the start of a bigger trend or just a blip on the radar. Now, when we turn our attention to some market technicals, it is notable that market breadth has been narrowing. So here in orange, we're showing the percentage of stocks in small cap, mid cap, and large cap in the US that are above their own respective 200-day average price. And you can see that that's at 54% as of last Friday. That is not a very strong reading. It's not consistent with bear markets, but it is not a very strong reading for long-term market breadth. So for the sustainability of this bull market, we would like to see that turn higher and stop seeing breadth narrow. Now, I say that, but I also want to emphasize that the uptrend certainly remains intact. So this is just a very simple technical indicator. We're showing on the dashed blue line the 50-day average price for the S&P, or sorry, for the MSCI US index. And then for the orange dash line, that's the 200-day average. And that bottom clip shows that the percentage distance that they are away from each other. So you can see that the 50-day moving average is still pretty strongly above the 200-day moving average. And that's consistent with a long-term uptrend that is intact and not necessarily breaking down. And then also when we turn to seasonals, we can see that seasonal trends are supportive. So the blue line in this chart is a composite that combines all 1-year cycles, all 4-year cycles, and all 10-year cycles that we've experienced in the S&P 500 together to give you kind of an idea of what market history says the year should look like. The orange line is what the year has actually looked like so far, and you can see that it's done a pretty good job picking turning points in the market this year. And if history is to be a guide, there should be some seasonal tailwinds here in the last 6 weeks or so of the year. Okay, so that's what we have for you today. The chart of the week, again, showing international markets have been leaders, even more pronounced when the indices are equally weighted and not cap weighted. There's been about a 5% correction so far in the S&P 500, and I do want to remind listeners that corrections are normal and can be healthy, but they don't necessarily mean that a new bear market has begun. Economic data has generally surprised to the upside, but we do want to watch some of the cracks, like the rising unemployment rate, to see if the economy is deteriorating any further or if it's still going to continue to surprise to the upside. Now, when we look at fundamentals, earnings are expected to come in below those Q3 levels for the end of the year, but above year-end 2024 levels pretty meaningfully. We do want to watch for any fundamental deterioration in the same way that we want to watch that unemployment rate. And then it's also notable to us that market breadth has cracked somewhat, but it is far from broken. It's not consistent with bear market trends, but we would like to see market breadth expand and improve. For now, we do continue to give the bull the benefit of the doubt, but we have flagged a couple things that we're watching that would change our stance on that. But for now, we do give the bull market that benefit of the doubt. So that's what we have for you today. As always, I want to thank you for joining us and wish you a terrific Thanksgiving in the week ahead.